Welcome back to another episode on Sunday where we're just going to talk about how my portfolio's doing and talk about some news where Elon Musk is now buying Twitter again. So let's get right into it. So this week, Elon Musk came out and said that he is going to buy Twitter for the agreed upon price after complaining about bots and practically accusing Twitter of fraud in their numbers of bots and fake accounts. He has now agreed upon the original price of around $54 per share to buy Twitter. And just a quick recap of what happened, Elon Musk made some pretty serious allegations saying that Twitter had overstated its active users, not accounting for the amount of bots that are on their platform. Now, at first glance, it may seem like Elon Musk is just giving up on the whole bot situation, and he doesn't want to go through the legal hassle, and maybe his lawyers don't even think that he'll be able to win a case to prove that they've overstated or understated the amount of bots that they've had on their platform. It's also important to note that this new buyout is contingent upon shareholders stopping their efforts to suing him in court. But regardless of the reasons and the lawsuits, it seems very likely that the Twitter deal will close in the next few months. Now, Elon Musk also tweeted out that this acquisition of Twitter will help him achieve the goal of creating the X app, which apparently does everything. Now, who knows what he means by everything, but it is promising to know that there is a bigger picture for Twitter and that we might actually get some serious new features. Now, there's a great deal of speculation as to what this X app could do and where Twitter fits in. And from what I have gathered from conversations and tweet storms and live streams from Elon Musk and Jack Dorsey, is that some type of payment platform would be on Twitter. Now, with Jack Dorsey having such tight relationships with Twitter and his company now, Block, which clearly has a lot of ties with Cash App and a lot of financial service payments, that could be a reality. Knowing that Elon Musk and Jack Dorsey are pretty close and agree on a lot of the similar topics, Jack Dorsey's Block could play a big part in this new Twitter revamp or maybe even the X app. Now, this is all speculation, and there have been no official announcements onto what the future for these apps will look like, besides some mysterious tweets and some cryptic answers on interviews. It's also interesting to note that Jack Dorsey has been very public about Block potentially coming up with some decentralized platform where the code is open source and the algorithms are far more transparent than all of the modern day social media platforms. Now, it'll be interesting to see how Elon Musk finishes this deal with Twitter and what the future is for the Twitter app, as well as what role Jack Dorsey and his team at Block will play in potentially helping create this X app. Now let's get into my portfolio and how it's held up over the week. I'm currently continuing to buy a little bit of the dips in companies I really like. For example, in my dividend portfolio, I'm buying Microsoft, Church & Dwight, and an ETF, SCHD. And in my growth portfolio, I'm more focused on Amazon, Palantir, Axon, and Google. So with Amazon, my cost basis is around 135, and now it's sitting at around 114. So I'm just trying to bring that down because I think over the next 5 years, Amazon will continue to increase their earnings. And the same thing with Google. My cost basis is around 119, and it's sitting around $100. And so I love the opportunity to scoop up more shares at a cheaper price. And we have Palantir, which my cost base is around 987, so 815. I love to pick up shares at that price as well. I also bought some Axon, which has performed pretty well in the past couple of weeks that I've had it, but I don't really care about the performance in the month, 2 month, 3 months. I care over the next 5, 10 years. So I hope, of course, that the share price stays suppressed in the short term, but over the long term, I'm excited to see what they can do. And now in my dividend portfolio, I increased my position in Schwab US Dividend Equity ETF. And that's just a real stable one for me. I just kind of put a little bit of money in there each time a paycheck comes in. We also have Microsoft and Church & Dwight, which I'll just continue to lower my cost basis on as the market continues to fall. I think these are both outstanding businesses that have great futures ahead of themselves, and I would love to lower my cost basis even more. Now, there's a lot of worries in the market, and the reason I've been adding to these positions is I feel like as a long-term investor, these prices are just too good to not buy a little bit. And although the broader market could fall even deeper if we start to enter an earnings recession or many other fears, I feel like these are really good long-term prices to get in at over the next 5, 10, 15 years. I'd also like to mention that 2 episodes ago, I said it may be wise for people who are worried about Deutsche Bank and Credit Suisse and their massive CDS spreads to stack some cash on the side while waiting. And with other worries of the Ukraine war and rising interest rates, there's a lot to be worried about. But in the past week, we've seen quite a rally in the markets, except for Friday, where it was quite a nosedive. And now, if you had a thesis around the market going lower and reaching new lows, you still may be correct, but it can be disheartening to see the stock market go up when you're expecting it to go down off of every factor that you think is important. But you have to realize that markets are very turbulent. They go up and down in really wild swings, even in bear markets. And we could see a 10 to 20% rally even while in a bear market. And now that's not to say that I'm super short the market and it can only go down from here. In fact, I haven't sold any of my long positions in any of the companies that I think are long-term value plays. Now, those risks we just talked about are still very prevalent, with the Ukraine war still raging on and possibly even escalating, as well as interest rates continuing to rise and crunching some businesses and even banks worldwide. But there is a light at the end of the tunnel. Eventually, inflation will most likely come down, and interest rates will stop going up and may even come down a little bit. And we all hope the Ukraine war stops as soon as possible, but none of us really know when or if any of that will happen. Now, I think that the best way to weather this market is to continue buying the stocks that you believe in and you think over the long term have good growth trajectories that can increase your value as a shareholder. It's also important to diversify what you're holding, because you never know what sector will take a huge hit or what will be disrupted. So it's important to find the best companies across the entire market and invest into those. Now, a lot of people try to time the market and want to win big on these huge ups and downswings of certain stocks or sectors. But I think a good way to think of investing, especially in these incredibly uncertain times, is to think of the economy and your businesses that you hold in terms of probabilities of outcomes. For example, I think that there is a slight possibility that we may go into a recession between the next 2 to 12 months. Therefore, I'm not investing as much as I usually do, and instead am holding it in cash, generating a 2.5% yield off of Fidelity's cash account. But I also see a far greater likelihood that in 20 years, we will reach far higher highs. And I continue to buy into the companies that I believe have a great future over the next 5 to 10 years that also have great fundamentals. So remember, although large sums of money can be made from timing the market perfectly like in 2008, preserving your buying power over time usually comes from objectively analyzing the current market situations and investing accordingly, as well as being constant and consistent with your investing strategy and tempering your emotions in big swings up and down. So what I'm doing is I'm buying a small amount of companies that I believe in and that I think have good fundamentals, and then I'm also saving just a little bit extra on the side in cash. Now, with that being said, I could be totally wrong on the probabilities of a recession and other market outcomes. But the reason you diversify is so you can't ever really be too wrong, and you can still preserve your buying power over time and by not investing in super risky assets in super risky times. So remember, to avoid big drawdowns, diversify into a wide variety of companies and ETFs that you think will compound your money over time. So thank you for tuning into today's video. If you have any questions or comments, leave them down below. And if you think I'm a freaking idiot and I'm totally wrong and I'm missing something, feel free to leave that down below as well.